We'll give it about another minute, let people trickle in. Okay, let's get started. Welcome to today's discussion of 1031 exchanges for 1031 Nationwide. My name is David Gorenberg. I'll be leading the conversation today. I do want to make sure that it is a conversation. If you have any questions, please feel free to raise your hand. There's an icon at the top of the screen. Or take yourself off of mute and interject. I'm happy to answer your questions. That said, let me share my screen. Works better if I push the right button. That's this one. And we will make these slides available afterwards if anybody wants them. Okay. So today again, 1031 exchanges. I like to start here with a quick overview of the Internal Revenue Code. Everything you need to know about the Internal Revenue Code is on this slide. If you make $1, it is subject to taxation. All income is subject to taxation, including illegal income, such as stolen or embezzled funds. If you make $1, you're supposed to report it on your tax return. If you believe $1 should not be subject to tax, the burden is on you to show why that dollar should be exempt. Section 1031 gives us a way to shelter some of our income, specifically depreciation, recapture taxes, and capital gains taxes. Essentially, what Section 1031 says, I'm not going to read the slide, you can do that, but what it says is if you have business or investment property, and you sell that property and receive only other business or investment real estate in return, you don't receive anything other than business or investment real estate, then you do not have to pay the capital gains tax on the sale of that first property. It is important to note that as written, Section 1031 is a tax deferral statute, meaning if you sell an investment property today as part of a 1031 exchange, and then you do another one in 3 years and another one in 5 years and another one 7 years after that, 15 years from now, you will have to pay, and when you sell that last property, 15 years from now, you will have to pay the accumulated, well, the taxes on the accumulated gain from today's sale, the one in 3 years, the one in 5 years, and the one 7 years after that. There's still, even if you're going to pay those taxes, there is still merit and value to the 1031 exchange if you understand the time value of money. And that's important. If you have to pay me $100 and you have 5 years to pay it, that $100 is worth more to you if you pay it in 5 years. You've had the use of that money for the whole 5 years. It becomes worth less to me because in 5 years there will be inflation and I have not had the use of the money. So even if you're simply going to kick the can down the road with your Section 1031 exchange and ultimately sell that last property, you have the value or the benefit of the time value of the money. You also potentially could be selling that property in 15 years when you are in a lower tax bracket. If we are all in our peak earning years now and we start selling things off after we've retired, presumably we would be in a lower tax bracket. Section 1031 becomes incredibly valuable, however, if we hold on to those properties until we die. If Grandpa does an exchange, and then he dies, he does not have to pay any of those taxes because he did not sell real estate as part of a taxable event. His heirs will inherit his real estate through at what is called a step up in basis, the fair market value of the property as of the date of grandpa's death. More often than not, real estate goes up in value. There have been times when it's gone down, but that's typically over a very short window of time. So if grandpa held his real estate for an extended period of time, the heirs would receive that property at the fair market value as of the date of grandpa's death. So let's move in and talk about the real value of a 1031 exchange to grandpa. So here is his current real estate situation. He has property that he purchased about 10 years ago for $300,000. In the last 10 years, he's made about $20,000 worth of improvements, and he has taken $100,000 worth of depreciation. So when he paid $300,000, that is called his cost basis. When we add the improvements and subtract the depreciation, the new number is what is called adjusted basis. So 300 plus 20 minus 100 is 220. Grandpa's adjusted basis in this property is $220,000. Now, grandpa was working with a really good real estate broker in a really good market, and he has now sold this property for $900,000. Excuse me. So when he sells the property for 900, we subtract the adjusted basis of 220, and we subtract the sale expenses, the brokerage commissions, transfer taxes, and the like. And in this example, that gives us a net capital gain of $600,000. This is wonderful news to grandpa. He made $600,000 on his investment. Is that right? Yes. So, but that $600,000 is subject to tax. Remember up above, we said that he took depreciation of $100,000. Well, at the federal level, he'll have to pay 25% tax on the depreciation plus state level tax. Now, depending on where you are in the country, some states do not have a state level income tax, for example, Texas and Florida. Other states like California, Connecticut, and New Jersey have very high rates. On this example, I'm using 4.4%. I believe that's Colorado. So in any event, grandpa is going to lose $29,400 in taxes on the depreciation recapture. He has capital gain of $600,000. So that's 20% to the feds plus another 4.4. There's $146,000 there. And oh, by the way, he is also subject to the net investment income tax, or the Obamacare tax, if some people will call it. That's another 3.8%. Grandpa, if he sells this property outright without doing a 1031 exchange, will owe $198,600 in taxes just from the sale of this property. I don't know about you folks, but I don't have a problem paying partners who work alongside me to run my properties. The last time I checked, the president and the governor did not show up to help me clean up after a tenant moved out. They did not show up to help me change a hot water heater or a garbage disposal or any of those things. I don't want to pay them. So I would much rather structure this transaction as a 1031 exchange. So what happens if we structure a 1031 exchange? Well, again, on the left, here's grandpa again, sells for 900. Capital gain is, the total gain is 600. He has 198,600 in taxes. He would walk away from the table with $621,400. But if instead he structures this as a 1031 exchange, he has the sale price, he still has his closing expenses, and now he walks away from the table with $820,000, or actually more accurately, that $820,000 would come to 1031 Nationwide to hold on his behalf. Okay, so far so good. And again, please feel free. I know some of you trickled in a little bit late. Feel free to raise your hand or take yourself off mute and ask a question. But this is huge, nearly $200,000 in savings on what here is a very simple, very vanilla transaction. And again, these slides will be made available to you after the event if you would like a copy of them. That's not a problem. $198,000 in tax savings. This is where some people would say, okay, David, this sounds really wonderful, but what's it going to cost? Well, if Grandpa sells one property and buys one property as part of his 1031 exchange with 1031 Nationwide, it's only going to cost him about $600. So $600 to save $198,000. I will take that return on investment all day, any day, every day. What's important to keep in mind is that Grandpa needs to get the qualified intermediary, 1031 Nationwide, involved in the discussion early. Those first two circles there on the left are interchangeable as to which one comes first, but it is absolutely imperative that the intermediary be involved in the transaction before we get to the closing table. Once we've left the closing table, there's nothing that we can do to fix Grandpa's transaction. He can call us from the car walking on his way to the closing table. I'd rather he call us before that. He can call us the day he gets a contract. He can call us the day he signs a listing agreement with the broker. He can call it the morning he wakes up and says, you know, I think I want to sell the property. It's never too early, but it can be too late. It's important because under the regulations, for this to be a valid 1031 exchange, there must be in place at or before the closing a signed exchange agreement between Grandpa and the qualified intermediary or the exchange accommodator, depending on which terminology you'd rather use. The next thing that's going to happen at the closing table or immediately before the closing table is Grandpa is going to sign an assignment. And that assignment is what allows the closing agent to send the sale proceeds to the intermediary. Absent that assignment, the funds go straight to Grandpa. Grandpa cannot touch the money. Grandpa cannot leave the money with his attorney. Must come to the intermediary. Now, if today, January 24th, is the closing date, Grandpa will have 45 days to identify a short list of potential replacement properties. We'll talk about that more in a moment. And he'll have up to 180 days to complete the purchase of those properties, of one or more of those properties. He may only buy something that he has previously identified. He cannot file or request an extension on his 45 days. He cannot request an extension on his 180 days. Those numbers are both in the statute. Keep in mind, if Grandpa is selling his property late in the year, and here we are in January, it's not important, but it's really 180 days or the due date of your tax return. So if Grandpa if Grandpa goes to closing after about October 15th, he's going to need to either complete his exchange by April 15th or file for an extension on his income tax return, not on his 1031 exchange. But here we are in January, that's not so important. When Grandpa is ready to buy his replacement property, we will coordinate with Grandpa and all of the professionals to ensure that there is another assignment in place for the purchase, and we will send the exchange funds to the closing agent so that everything runs smoothly. If Grandpa is communicative, it's almost as if we are not involved. There's very little noticeable if everybody keeps everybody in the loop. Okay, here's another variation of that same timeline, just a little less complicated. Today, closing day is day 0, 45 days to identify, 180 days to complete the acquisition. We're going to talk in a little more detail about these things in just a moment. Section 1031 is also called a like-kind exchange, and I want to spend a moment talking about like-kind before we get back into those time limits. Like-kind seems to confuse a few people. We frequently get a phone call where somebody says, "Oh my goodness, I just sold a condo and I'm having trouble finding condos I like in this community." Or I just sold a warehouse and I'm having trouble finding a warehouse I like in this community. That is not what like-kind means. The like-kind phrase was very important a few years ago when 1031 exchanges applied to more than just real estate. As of 1/1/2018, it's only real estate. And if you look at this picture here, all 8 of those properties are like-kind. They are all investment real estate. So whether I'm selling raw land or a single family rental or a duplex or an apartment building or a golf course or a shopping center or a warehouse, an Amazon distribution facility, whatever it is, real estate is real estate is real estate. It is all like-kind. Okay, so don't get hung up on making sure that the properties look the same or they're used exactly the same. If it's business or investment real estate located in the United States, it's like-kind. All right, let's get back to those time restrictions for a moment. Again, it's 45 days, 180 days. It's calendar days, not business days. So if we end up with a 3-day weekend for a federal holiday, or a religious holiday, or those don't grant extensions. It's calendar days. Now, we talked about what does identification mean, or we talked about identification. What does it mean? Well, the identification must be in a written document signed by the taxpayer. They can't simply call us up and say, "Hey, we want to buy 123 Main Street." That doesn't work. It must be in writing. It must be signed by the taxpayer. Signing today in 2024 includes electronic signatures. So you don't need to print a piece of paper out and get out your pen and sign it and then mail it to us. You can sign it electronically. If you feel more comfortable printing it out and sending it to us, that works too, but you don't need to. The identification must be unambiguous. Generally speaking, the vast majority of the identifications we receive are street addresses, 123 Main Street, for example. But a legal description would also work. So whether it's a tax parcel ID number or a tax lot and block number or Township 6, Range 3, whatever it might be, the idea is that somebody from that community should be able to take this piece of paper, walk down the road and say, "Yep, this is exactly what Grandpa identified." Similarly, if the property has a distinguishable name, Madison Square Garden, for example, the regulations say the Mayfair apartment building, theoretically, everybody in town knows what that building is. In fact, down the road here from me is Johnson's Farm. Down the road the other way is the Springdale Farm. I have no idea what the street address is of either of those properties, but I can get you there with my eyes shut. And that's the point. If Grandpa changes his mind, he can do so during the 45 days. So if on day 30 he submits a list to us, and then day 39 he changes his mind, that's okay, as long as we're still within the 45-day window. Once we've hit midnight on day 45, the list that he submitted is baked, and that's the list we have to work with. And I keep referring to lists. So how long can Grandpa's list be? This is important. When I first started teaching these classes almost 25 years ago, I would carry with me a phone book. And typically I would actually borrow a phone book from whoever office I was teaching in. And whether I was in Pittsburgh or Philadelphia or Peoria, it didn't much matter. I would pick up the phone book and say, okay, I'm buying one of these properties. And how many addresses are there in your town? And whether we're talking about a major metropolitan city or a little urban community, it doesn't matter. There are thousands and thousands of addresses. So the regulations give us a limit. There are 3 rules on this page. Grandpa only needs to comply with one of them. So we start at the top of the page. Grandpa can identify up to 3 properties, no further questions asked about anything else. If he identifies 1, 2, or 3 properties, that is fine. A word of caution. When someone identifies to us 1 property, I get a little paranoid, because the odds of any one property making it to closing, can vary. If Grandpa has the property already under contract, it's already gone through due diligence, the date is locked, it's going to close next week, I'm not worried about it. But if Grandpa is still negotiating and today's day 44 and he wants to make sure that he gets it on the list, I want to suggest to him that he provide me with a couple of alternatives. Because either once he signs the contract, he finds something wrong with the property and he won't buy it, or he may not get a contract because he gets outbid by somebody else. So I get a little nervous, sometimes more than a little nervous, when an identification comes through with only 1 property. Grandpa can say, I wish to buy 1 of these 3 properties, that's fine. Or he can buy all 3 or any combination along the way. But we work very closely with them. The operations team who would be communicating with Grandpa will be very interactive and ensure that he is comfortable that he'll be able to complete his purchase. Now, what if Grandpa decides that he wants to identify more than 3 properties? This is important because frequently Grandpa will look at his real estate transaction and say, this is a good time for me to start doing some estate planning. Grandpa has 5 grandchildren, for example, and he doesn't want to leave 1 shopping center to 5 grandchildren. That would be a recipe for a family feud. So Grandpa could identify 5 replacement properties, 1 for each grandchild. Well, that's fine, but 5 is more than 3. So we've already violated the first rule. Let's look at the second rule. The second rule says you can identify more than 3 properties, but you must limit your list to not more than 200% of the value of what you sold. So in our example, Grandpa sold his property for $900,000. He can identify 5 properties as long as his list, as long as the value of all of those properties on his list is not more than $1.8 million. I'm going to pause and see if there's any questions, because this is where typically a question or 2 might pop up. Don't be embarrassed. I assure you, if you have a question, somebody else is thinking about it also. Guaranteed 100%. Also gives me an opportunity to take a sip of water. Okay, we'll move on. So Grandpa will either identify up to 3 properties or he'll identify more than 3 properties and keep the list to not more than double the value of what he sold. Okay, but there's a third rule. And the third rule says if you have violated the first 2 rules by identifying more than 3 properties and their value is more than double the value of what you've sold, now you must acquire 95% of the fair market value of what you've identified. So I'm going to use a simple example. I'm throwing Grandpa away for a moment. We sold a property for $100,000. We've identified a dozen replacement properties, and they aggregate to $1 million. So 12 is more than 3, and 1 million is more than double 100,000. We must complete the purchase of $950,000 worth of identified value. Now, on the day of the identification, we would need to know the approximate value of each of those 12 properties. If you end up paying $500,000 for properties number 1 and 2, but properties 3 through 12 are still out there and you didn't buy them, it's reasonably certain in my mind that you have not acquired for the value of those properties. We need to, we're acquiring value as of the date of identification. So here again, the team is very proactive. When a taxpayer is using the 95% rule, we want them to understand very clearly that property number 1 was $100,000, number 2 was $150,000, and so forth. We add them all up. More often than not, if somebody is using the 95% rule, it really means they're buying everything on the list. I will tell you over the past 25 years-ish, roughly 95 or 96% of our transactions have used the 3 property rule. 99% of what's left have used the 200% rule. And now there's some itty bitty little fraction that falls into the 95% exception rule. And almost every one of those people has bought everything on the list. Well, if you buy everything, then you've bought 100%, you're okay. More often than not, if you fail to buy everything on the list, you're not going to satisfy the 95% exception. So, word to the wise, we want every taxpayer to have all of their questions answered. So we want to be very proactive in dealing with these identification rules. Okay. If you are only going to remember, oh, I see a hand. Cynthia,
Yeah.
yes.
Yes, I have a quick question. So to make sure I understood that right, if you violate one of the if the first 2 rules are violated, then you have to meet the exception, not the other way around.
Correct. Yes, you start at the top of the page. Thank you, Cynthia. Very important clarification. And like I said, you had that question. I'm sure somebody else was just as confused. And who knows, maybe I'm confused. We start at the top of the page. There are 3 rules there. We first seek to satisfy the first rule. If we satisfy the first rule, we can throw away the other 2. We violate the first rule, we now move on to rule number 2, and so forth. Last year, the year before, I was working with a taxpayer who was trying to satisfy the first 2 rules at the same time.
Oh.
Well, by definition, you can't, because rule number 2 says if you have identified more than 3, and she couldn't make it work. And she was one of these people, she just didn't quite listen. I wanted to grab her by the scruff of the neck and just shake her a little bit. She ultimately got it, but not because of anything I said. So yes, thank you, Cynthia, for asking that question.
Perfect, thank you.
While we're paused here, other questions? Okay. So if you are only going to remember one slide from today's presentation, this is the slide I want you to remember. This is everything you need to know about 1031 Exchange 101. This would be like first grade level 1031 Exchange, all on one page. The second most important thing beyond this page would be remember to call 1031 Nationwide. But this page, in order for our taxpayer to fully defer all of the gain from the sale of their business or investment real estate, they want to be able to check off every one of these bullet points. Number one, they want to only receive like-kind property at the end of the day. So if they have anything other than real estate in their hand when the dust settles, whether it's leftover cash or a boat or a piece of equipment or livestock, that the value of that becomes a taxable event. So if they sold for $1 million and they only bought for $950, the $50,000 that they didn't spend is a taxable event. If they sold for $1 million and bought $1 million, but the $1 million purchase came with a little boat that's tied up at the dock out back, the value of that boat is a taxable event, and so forth. Okay. They need to ensure that they comply with the 45-day identification and the 180-day acquisition time limits. Again, no extensions. The IRS will periodically grant a blanket extension in the event of a natural disaster, Hurricane Katrina, for example, or the terrorist activity such as 9/11. But those are the kinds of things, the Hawaii wildfires last year, California seems to get a wildfire every year or so. They get an extension. Um, but those are the only ways that people will get an extension. And you as the taxpayer can't ask for it. The IRS grants it on their own time. You want to ensure that you buy property of equal or greater value to what you sold. I see another hand raised. Jackie, yes.
Can you explain after you go through this sheet, can you explain to me a little bit about a partial 1031 exchange?
Absolutely. That's a wonderful question. I absolutely will.
Thank you.
Please, no, thank you. In fact, on this bullet point is a great place to discuss it. In order to fully defer all of the taxes, Grandpa wants to buy property of equal or greater value to what he sold. So let's go back to our original example, right? Grandpa sold that property for $900,000. For a fully, for full tax deferral, Grandpa will want to buy new property worth $900,000 or more. To Jackie's point, if Grandpa says, I sold a $900,000 property, the only thing I found that I want to buy is $800,000, he can do that. Remember, we calculated that he had $600,000 in gain. The $100,000 that Grandpa is not reinvesting will first be looked at as depreciation recapture. My recollection is that Grandpa had $100,000 in depreciation. So Grandpa would be paying 25% depreciation recapture tax to the feds, plus his state level tax on that number. If there was no depreciation, it would be capital gain. You'll never pay tax on more than what you did not reinvest. Here's an interesting time to interject an item that's not even in the slides today. When we have a situation where Grandpa says, I can't find anything I like that's more than 800. So it's not like he was intentionally not reinvesting the 100. We have that sometimes. Grandpa will say, you know what? I want to pull 100 out. I know I'm going to lose a quarter of it or so to taxes, but I have 5 grandchildren. I want to give them each $10,000. Okay, fine. You pull out 100, you pay tax on it, you give the grandchildren $10,000, you got a few dollars left over. No big deal. But if it's not intentional, it's simply that grandpa couldn't find anything that he likes. If we find out about this before we get to the 45-day deadline, we can educate grandpa about a Delaware statutory trust. I'll spend just a minute on this. A Delaware statutory trust is a lot like a real estate investment trust in that you have pooled your money with a few thousand of your best friends that you've never met. And together you have bought an institutional grade property. It could be a shopping mall, an office building, an apartment building. A few years ago, ESPN sold their corporate headquarters in Connecticut as part of and the purchase was part of a Delaware statutory trust. The benefit to grandpa is that he's now spent his remaining $100,000, and this portion of his investment is completely hands-free. No management headache. He gets a check each month. It's actually electronically deposited. He still gets the benefit of depreciation on the structure. And in 5 or 6 or 7 years, when the trust decides to sell that property, he can do a new 1031 exchange and continue to roll his investments. But to Jackie's question, directly to Jackie's point, if grandpa sold for 900 and only reinvested 800, then what he did not reinvest would be subject to tax. It does not kill the entire exchange. It's only that difference. Last week I had a conversation with somebody who, by the time we figured out, we estimated what his gain was on the property and what he was looking to reinvest, he wasn't sheltering enough of the gain to make spending money on a 1031 exchange worthwhile. So he ultimately is just going to pay the taxes. He was basically reinvesting a very small fraction of the sale price rather than the vast majority of it. So thank you, Jackie, for asking that question. Now, the other thing that has to happen with grandpa's transaction is that he needs to reinvest all of the equity. So on our example, we didn't talk anything about whether grandpa had any debt on the property. And when he sold for $900,000, if he generated $900,000 in cash, he wants to reinvest, or he needs to reinvest the whole 900. What we see sometimes is that, so let's say grandpa sold for 900 and he paid off a $100,000 mortgage. $800,000 came to the QI, and now he's going to buy a new property. He's found a property he likes for $1.2 million. So he's trading up in value. And his lender says, Grandpa, you're a good guy. You've got good credit. We will finance 50% of that purchase for you. So it's a $1.2 million property. The lender's going to provide $600,000. Grandpa only needs to come up with the other $600,000. Wonderful. Grandpa has traded up in value. However, he still has $200,000 left in his pocket when the transaction's over. That extra $200,000 becomes a taxable event anyway, even though he bought a property worth more than what he sold. So again, here's where our team becomes very proactive and works with grandpa to understand, to make sure that he understands that he needs to reinvest all of the cash. Grandpa can refinance after the purchase if he wants to have 50% financing on the property. And when he does that and he pulls out some cash after the 1031 exchange dust has settled, then there is not a taxable event. When grandpa sold on our last example, paying off a $100,000 note, when he buys the new property, he needs to replace that mortgage either with a new mortgage or new cash. I tend to focus less on this bullet point than the two previous. Trade equal or up on value, equal or up on equity, and the debt will balance automatically. So those two in the middle, equal or greater in value, equal or greater in equity, you should put big red stars next to those. If we trade down on either of those bullets, we have created a taxable event. Back to Jackie's point. And then the last bullet point on this page is that the taxpayer needs to avoid even constructive receipt of those proceeds, meaning that they can't leave the funds in their attorney's trust account over the weekend while they figure out what they're doing. The attorney is an agent of the taxpayer. When the attorney takes possession of the money, it killed the exchange immediately, and we can't fix it. I can't tell you how often each year we get phone calls, typically on a Monday or Tuesday, about a transaction that took place last week. And the attorney says, yeah, my client decided he wanted to do a 1031 exchange. Well, that's good. If you have a transaction that closed last Wednesday, that's when you should call me, is last Wednesday. I can't fix last Wednesday. I can fix next Wednesday. I can fix tomorrow. I can even fix this afternoon. But I can't fix yesterday. All right. Up until now, we have been talking about the concept where we sell one property today and buy a new property tomorrow, sometime in the next 180 days. A typical transaction where we sell first and buy second. But every once in a while, a situation comes up where we need to buy the new one before we sell the old one. Excuse me. I'm going to pick on Jackie because she's the last one who raised her hand. Jackie has a buddy who has an apartment building. Jackie has wanted this apartment building for the long time. Jackie has continually said, look, if you're ever going to sell, let me know. If you're ever going to sell, let me know. And Jackie gets a phone call. Hey, Jackie, I'm looking to sell my property. I will sell it to you for X, but you have to close in 30 days. Well, Jackie knows that if she does not jump on this offer and she then has to fight with other bidders in the open market, she's going to pay considerably more than X. So she enters into an agreement to buy that white apartment building on the bottom of the page. And she will buy the white apartment building, and then she will sell her existing building afterwards. So here's what happens. Jackie is going to have to, in some way, shape, or form, lend to us the money to buy that white building on her behalf. If she has it in her back pocket, under her mattress, or in the bank, that's great. She will lend that money to us, and we will buy the property on her behalf. More often than not, she does not have it under her mattress or in the bank, and she's going to go to her lender and borrow the money to buy this new building on the left here. We will form an LLC specifically for the purpose of buying this property. We will buy it for Jackie using Jackie's money. We will lease it to Jackie on a triple net lease, meaning no cash changes hands. The consideration that Jackie provides is that she will be the property manager. She'll collect the rents from the tenants. She'll take care of the landscaping and the snow removal and all of that other stuff. And then she will continue to market her existing property for sale. If she sells the old property within 180 days, we have a valid 1031 exchange. Notice it's the same 180 days. The cash from the sale of the red building will flow to us. We will then pay it over to Jackie to pay off the loan that she gave to us to buy the property on her behalf. And we will give her the title to her property, her new property. Depending on a variety of factors, we will either give her the LLC or we will transfer the property by deed. Different conversation for a different course. So if Jackie sells the red property within 180 days, we've got a properly structured reverse 1031 exchange, or sometimes called a parking exchange. If she does not sell the red building within 180 days, then there's no taxable event. Purchasing the white property did not create a taxable event. So the worst case scenario is that Jackie does not sell the red one and she ends up with 2 properties instead of 1. Best case scenario, I mean, unless Jackie wanted both in the first place. Best case scenario, she sells the red property, we deferred the taxes, rolled everything ahead into the white property. I'm going to pause for a moment because this can be confusing. Questions from anyone?
Just to be clear, if a
Yes.
person sells their own property, once it sells, if the money is not given directly to an intermediate person such as yourself, it can no longer be done as a 1031 exchange, correct?
Correct. The qualified intermediary, in this case 1031 Nationwide, must be involved in the transaction before we get to the closing table. Whether it's a forward exchange or a reverse exchange, the intermediary must be involved before we get to the first closing table. So on the reverse exchange, once we have purchased the white property, it's too late to set up. That's not entirely true. We have a couple of days leeway on a reverse exchange, but we need to know on a traditional forward exchange, we need to be involved before the closing. Once the taxpayer has touched the cash, it is too late.
Except for if they sold a property and then in the next 2 to 3 days, they notify you and give the funds to you, then they can still do a 1031?
No, if they've sold the property, it's too late.
Okay.
If they're
Okay.
buying first, if they're doing the reverse exchange, they can have up to 3 business days to get us involved. It's hairy, it's complicated, and it's cumbersome if that's what they're doing. Because then we have to park the old property, and that creates logistical headaches with the lender on the old property. The bottom line is, forget that I said anything about they have time leeway. The bottom line is that the taxpayer should get us involved before they get to the closing table on whatever it is they want to be part of a 1031 exchange.
I had a quick
Yes.
question in regards to the whole loan situation that you said in the reverse one,
Yes.
where so essentially they go ahead and they buy and they get the loan from the lender, but the loan is held by you guys because then when they sell it, they pay it back to you.
So Cynthia, so now you're the person doing this reverse exchange, okay? So we're going to leave the same slide here. You're going to go to your lender, and the lender is going to lend money to you, and to the LLC that we have formed to buy the property.
Got you.
Okay, so and I'm going to call the property like New Property LLC or something like that. So the lender will lend the money to Cynthia. Actually, they'll lend it to New Property LLC, but you will be the guarantor.
For it. Okay.
Right.
Got it.
Right. Now, when you ultimately get to sell your red one within the 180-day window, the cash will flow to the intermediary just like it did previously. But now I'm going to pay it over to you because you loaned the money to me, or in this case, with the lender involved, we'll pay it directly over to the lender. Either way, it's going to pay down the loan that we needed to buy the white property.
Got you. Okay. And then with the LLC portion, does it have to be an LLC created by your guys' company, or could it be an LLC that I might have, let's say, already?
It could, so it does not have to be one that we form. It does have to be one that does not have any other assets. And depending on the structure, it may not work if it's one that you already have.
Okay.
One of the things that we have to keep in mind, Cynthia, is that if the property that you sold was in your name alone, right, not with a spouse or a buddy or whatever, but the LLC had multiple people in it, then it's a problem. Similarly, if the property that we are selling is you and a spouse, that creates a new issue. right? And if it's you and a college roommate or, your high school best friend or your mother or whatever, creates a whole other set of issues. So more often than not, look, we always have a conversation before we form the LLC. I will tell you that historically, 98% of the time, I form the LLC for you. I charge less than your attorney's going to charge. Now, if you're somebody who's really active and you want to go online and do it yourself, I won't stand in the way, but I'll give you a checklist of things that you have to do to get it right. Yeah, because if you muck it up, it doesn't help us any.
Okay. And then my last thing, only it's just because like I do process loans. So I was curious because I know that certain programs have a clause where if you try to pay more than 80% of the capital, oh, no, sorry, 20% of the capital, they like within a certain period, it causes that clause to go and you have to pay the full thing. In this case,
Yeah, so with a reverse exchange, not all lenders will participate, right? Because the title isn't in your name, Cynthia, right?
Yeah.
And they need to understand that that a known portion, give or take a few dollars, is going to be prepaid early.
Got it.
Right? So sometimes you'll go out and you'll apply for essentially a bridge loan.
Got it. That makes sense.
In my experience, the folks who have the most success using financing in a reverse exchange are those who either A, have an existing strong relationship with a lender, or B, go to a mortgage broker rather than just the local bank.
Got it.
Right? Because sometimes the local bank, they hear reverse exchange and Cynthia's buying property and it's going to be held in somebody else's name. They want nothing to do with it.
Yeah.
Right? So, but again, this is one of those times where we can be proactive. We can get on a conference call with you and the lender, you and your attorney, you and your CPA, whatever needs to be, so that we all make sure we're all on the same page moving forward.
Perfect. Okay. Thank you.
Wonderful. Thank you. Good questions. Good questions. So let's take this same basic concept of the reverse exchange. Let's go back to Grandpa for a moment. Let's say he bought this property on the top here for $800,000 and it needs $100,000 worth of repairs, right? Remember, he sold for $900,000. All right, this one admittedly needed more than $100,000, but you understand my point. He's going to buy the property on the top of the page here for $800,000. Using the same basic structure from the previous page, we're going to buy that in an LLC for Grandpa using his money. Remember, I'm holding the money in our account on his behalf. I will write the check. I'll send the wire. It's in the LLC that I've just created. Grandpa's going to hire contractors to do the roof and the siding and the windows and the landscaping. And as long as he can get all of this work completed within 180 days and turn that rough lump of coal at the top of the page into that beautiful shining diamond at the bottom of the page within 180 days, he's done that all as part of his 1031 exchange. An improvement exchange does not work well if Grandpa is going to be building from the ground up. But if he needs to replace the kitchen or the bathrooms or the roofing or the siding, those kinds of things, not so bad. Okay. I just want to touch on one last bullet point before we get to the end. We're running up on the end of our time, and then we'll have a couple minutes left for some questions. The other thing that comes up periodically is a situation where perhaps our investor lives in that green building. There is 6 units, 2 retail on the first floor, 2 residential on the second and third floors. If our taxpayer lives in one of those units, 5/6 of that property would be a 1031 exchange. The other 1/6 would be their home. Similarly, the picture at the bottom, a real transaction I had a couple of years ago in Pennsylvania. They lived in that house, and the rest of the property was a horse farm. Here, it's not as easy as 1/6, 5/6, like we had at the top. They had two different appraisals done, one for the value of the house without the farm, one for the value of the farm without the house. And using those two numbers, they came up with a ratio. And when they got a contract for the sale of the entire property, they applied that ratio to the sale price. So in both of these situations, we're going to want that's you, that's the investor, that's the tax, that's us, the 1031 company, their attorney, their accountant. We're going to want to have a team call to make sure that we know what we are doing before we get to the closing table on the sale of that relinquished property. So here we have about 3.5 or 4 minutes left. I'm going to open it up again one more time for questions. Please feel free to take yourself off of mute and ask me whatever you wish.
Hi, this is Stacy. I have a question. You
Yes.
kind of answered part of it in the last two slides. Because ADUs are now going to be sellable and financeable independent of the, let's say, the house that it belongs to or belonged to, have you seen any of those transactions as of yet? In terms of exchange of just the ADU?
Please define the term ADU for me so I make sure I give you the right answer.
Accessory dwelling unit. So that now, we have to in California have build with an ADU in mind. And then you can get a junior ADU, a full ADU. It doesn't have to be attached, doesn't have to be detached. It just depends on how it fits into the property. So if you're selling that, or if your use is a partial, like you just said, you could exchange that into a value of similar value, a property value.
Whatever we want to call the property, whether I have a farm with the house that I live in plus 3 other outbuildings, whether I have a duplex and I live in one half, whether I have a property that's an Airbnb, for that matter, even a bed and breakfast, right? In a bed and breakfast, I'm living in one suite and people are living in other units, right?
Mm-hmm.
All of that is eligible. The question is, how are we going to do the math?
Right. An appraised value is clean, I would imagine.
And it depends. So like on the farm in this example, my client was very astute. They had good advisors and they had gotten 2 separate appraisals from 2 separate professionals, each one completely ignoring the existence of the other.
Okay.
Right. So that's awesome.
Yeah.
I had a similar so this green property here with the 6 units, I had a similar property, similar but not really, in New York City last year. The investor owned a 7-story apartment building, but it was one of these skinny little apartment buildings where each floor was only one apartment.
Right.
And she charged more rent for the unit on floor 2 and more for the unit on floor 3, and she lived on the 7th floor. So arguably her unit was more valuable than the other 6. And she didn't take 1/7 of the property, 1/7 of the value of the property for her homestead and 1031 the exchange, the other 6/7. I think the math was more like 1/6 of the value was her homestead and 5/6 was the remainder. The bottom line is if we use, not we, I don't really care. If the taxpayer uses something that is commercially reasonable, ultimately their CPA is the one who's going to be with them in tax court, not me and not you.
Right. I get it. The second part of the question is when you talked about lenders who in a reverse, could the lender the lender can be a private lender?
Oh, 100%.
Okay. And would you, if you were going to exchange into a property where that private lender might own part of it, would you stay away from that because it's not arm's length in a way? Or how?
I've seen situations where the private lender takes a piece of equity.
Uh-huh.
And that's okay. Again, Stacy, making sure that we know that if you sold $500,000, you need to have at least $500,000 worth of ownership interest in the new property.
Got
So
it.
we have to, right? So when you're buying as tenants in common with somebody else,
Hmm.
now we have to make sure the math works on that as well. But
Gotcha.
otherwise, it's fine.
Okay. The last piece was, I get this a lot because I sell a development that's a conversion where sometimes there's a lot that I sell and sometimes it's the whole kit and caboodle, which used to be a manufactured or mobile home that's affixed to the land. So therefore it becomes real property. People have come to me before and wanted to exchange into it, but let's just say they start with a lot. You're saying on the improvement slide, you could foreseeably do that, just do it within the 180 days. So if you have your home manufactured or modular or whatever home, stick built even, you just need to complete it. But are you going to mark both things, the acquisition price of the lot and the acquisition price of the home you're going to put on the lot?
Very good question. Yes, if we're doing an improvement exchange, we need to identify the improvements as well. So if it's a modular home, we're going to say, the lot at 123 Main Street plus, Jones modular home, or it actually doesn't have to be that specific, plus 3,000 square foot modular home, whatever it is.
Right.
Right. I don't have to pull out a page from somebody's catalog and say, this is what it's going to be.
Got it. Okay.
I have had taxpayers who are rather anal in their descriptions of what it is that they're going to be doing for improvements. The bottom line is, here's the way I like to explain it. If this were your exchange transaction right now, Stacy,
Mm-hmm.
if an IRS agent showed up at 5 o'clock in the afternoon on day 180 with the piece of paper that you gave me on day 45, would they be able to say, yes, Stacy, what you gave David is what I see in front of you?
Got it. But it's possible. It's a common question. And I guess it leads me to ask, do you ever have the buyers or the people who are parking money waiting, maybe didn't meet that 180 and they need someplace to go? Do you ever match up people?
Years ago, I tried doing that. It took more effort to do that than to run the 1031 business.
Mm-hmm, mm-hmm.
But at the same time, look, if you call me up and say, David, I have somebody who's selling, a 2-acre ranch in Sonoma County, I'll see if I know anybody.
Right. Okay. Because that's where I would say, based on the value of the lots that I sell or the whole, even the completed package, if you will, with a house on top of it, it's very reasonable for Silicon Valley. The prices are very reasonable, and it's depending upon where you're exchanging from, that's probably nothing in comparison
Right.
to it fills whatever, let's say, boot or whatever leftover you might need. And that's what I was asking about. Yeah.
Yeah. So here's the bottom line. Beyond today, and I still see that there are a few more questions, and we'll get to those. Beyond today, if you have additional questions about 1031 exchanges, call David Weissman and the team at 1031 Nationwide. We'll make sure that we get your questions answered.
Okay. Thank you.
My pleasure. I see multiple hands. Dario am I right?
Yes, correct. Actually, I'm gonna ask you something that maybe say before, but I was in a mediation and I jumped in late, so I'm gonna ask it. Let's, for example, I have a property that I purchased for 250,000. I put 100,000, 150 was a loan. Okay. Now I selling for 450. What is my equity? Do I have to purchase something for 450 or over? But actually, I don't have the money to do that. And at the closing table, the bank is gonna take. Let's say I didn't amortize anything. I still own 150. Just
I understand you
example.
100%. I understand your question 100%, Dario. the sale price of the property is what you have to look at. Today, Dario, you have a property that has a mortgage on it, and you're going to pay
Yes.
off the mortgage. And when you buy the new property, you'll have to get a new mortgage
Correct.
or come up with cash from another source.
The only thing that I have, the cash that I put in the purchase, 100,000 plus,
Right.
let's say I make it
Plus the
200
equity. I
to
get
make
it.
it. Yeah,
Yep.
let's say
So
the
you'll have to
equity is
borrow the
200.
money to make up
It's
the
gonna be
difference.
less. It's gonna be less. I have
Yeah.
to borrow the money.
You're going to have to borrow the money because if you don't reinvest the 450, you've created a taxable event.
Okay. Okay. So in the
Okay.
meantime, in those 180 days, I had to qualify. Not only get the property within 45 days, I had to qualify for the loan that I need.
You should start looking for your loan and for the property as soon as possible.
Okay, understood.
Wonderful. Okay,
And,
Rosa.
Quick,
No, sorry.
another question. Another quick question that I 100% it wasn't saying anything about this. Can you buy in an exchange a share of a commercial investment?
You can buy a fractional interest in a commercial investment as tenant in common, but you cannot become a partner in an investment, an ongoing investment. You must be on the deed as tenants in common.
Okay. Okay. Thank you.
My pleasure. Rosa, I believe you have a hand up. No? Maybe? Okay. Any other questions? Again, on behalf of Tim, yep.
Yes, I can do another question. What if I do, for example, lots? I don't buy a property, house, duplex, nothing. Just I sell in my condo and I gonna get lots to build in the future.
Yeah, you can buy a lot. You can, as long as you are buying real estate, you can buy a lot. You can buy a townhouse, a warehouse. It doesn't matter. As long as you are buying real estate that will be used for business or for investment.
Okay. It can be a couple of lots, for example,
And you can buy more than one. Yes,
to make sure I going over the value.
correct.
Okay.
Wonderful.
Okay. I'm fine. Thank you very much.
So I want to thank everyone. I apologize that we've gone a little long. I appreciate that you're willing to stay here for the duration. On behalf of 1031 Nationwide, I want to thank you for your time today. And if you have questions beyond today, please give us a call. Thank you all. Have a great day.
Sure.
Have a nice
Thank
day.
you. Bye-bye. Bye-bye.